Awesome. Well, if you're not already viewing my screen, be sure to do that because that is where we'll be hosting the slideshow for today's content. But welcome to OBR Biweekly Class 17. We've been doing this for over a year
Is
now.
it 17? Is that the accurate number? Wow.
The number's been skewed a couple of times, but I think that this is the accurate number.
Okay, let's go.
So we, as always, appreciate your guys' attention. We appreciate your time, especially 1 p.m. on a Saturday. You know that means you're dedicated to learning and improving your skills. So today we definitely don't want to waste any of that time. We're going to be talking about macroeconomic analysis. So let's just jump right into it. And we're going to, Austin, would you like to split the slides the way we usually do? Would you like to do your slides? I'll do my slides.
Yeah, well, it doesn't really matter to me. I'm fine with whatever. I didn't make your slides, so I might have.
So I'll do my
a
slides, you
little
do
bit
your
of
slides, Ben will do his
Okay,
slides.
let's do it. Let's do
Good
it.
deal.
Sounds great.
So, when I am looking at macroeconomic data, the first thing that I'm going to be keeping my eye on is macroeconomic releases. And not all of them, but a lot of them. And majority of them are going to be around the high impact news events. And there's all different kinds of news events depending on the severity of whatever it is. But some of the main ones I'm looking at are CPI, Consumer Price Index, Core CPI, PPI, Producer Price Index, Retail Sales, Federal Funds Rate, FOMC, the Federal Open Market Committee, Unemployment Rate, the Non-Farm Employment Rate, and Advanced GDP. So we're going to be going right into those. So this data is data that's released, as you guys are probably aware. We had CPI data just, this last week. And Consumer Price Index is the change in the price of goods and services purchased by consumers, so everyday people like you and I. This data is released monthly, about 16 days after the prior month ends. And Core CPI, which we said in the last slide, is the same thing as CPI, but in its calculations, it is excluding food and energy. So why do we care about the Consumer Price Index? Consumer prices account for a majority of overall inflation. Inflation is important to currency valuation because of rising prices lead the central bank to raise interest rates out of respect for their inflation containment mandate. And that's a whole different conversation about the mandates that central banks have, but amongst three of their main mandates is keeping inflation steady. So we get to see the change in inflation via the Consumer Price Index. And we're going to go deeper into the federal funds rate and interest rates in just a couple of slides. But how do we find CPI? It is the average price of various goods and services, and they are sampled and then compared to the previous sampling, so the prior month. So we see the change in month over month, and that's why last month's data came in at 1%, moving our annual inflation to 8.6%.
And I want to say before we move on from that,
yes,
I mean, you guys saw when that CPI data came out just the other day, you saw the impact it had on the market, right? It was absolutely ridiculous. I believe, what was the move that we saw, Logan? It was like 2.5%.
Yeah, it was about almost
like
3%. Yeah.
So when Logan's talking about these macroeconomic releases, like they're legit, right? They're high impact news on the market. So
yes,
yep.
And we are going to go into that a little bit deeper, but that's why it's so important for day traders to really know about these releases, is because especially the high impact news events, if you're in a trade and you don't know one's coming, you lost right there. You need to know when these things are happening, or else you are behind.
Yeah, I can't imagine trading that CPI day without being aware that CPI data was coming out, right? You're like, what the heck is going on? And then, you're just lost. So
yeah.
Thankfully,
you guys have us, and we shout it in your ears 12 times a week before it happens.
But, and then we're talking about it more here.
Right.
Right.
But Clayton and Ben, if you guys have any thoughts about, CPI, feel free to chime in before we move on.
Sure. So, I mean, I think when it comes to the two metrics of core and the CPI itself, I pay attention to core. Those at least have longer term implications in the sense that food and energy are extremely volatile, which is the why of why they have that metric in the first place. So when it comes to at least how I would use it in regards to my gauge on the economy or the macro, I'm a big proponent of the core CPI.
I like that. I feel like that's a hot take because most people just look at CPI, but I like that perspective.
Thank you. Yeah, I mean, I think, like you said, although it is, it sucks to say that one of two numbers or one of these numbers can make or break the market, but they are incredibly important to pay attention to. And that's what we do every single time that it comes out. That is the hot topic for the week.
Right. Absolutely. As with most of these high impact news events, actually, they are usually the hot topic of the week. Like this week, actually. Oh, sorry. Was somebody going to say something?
Oh, I was just going to chime in quickly. Usually, the biggest thing for these is these are usually factors that we do not necessarily want to consider. It's the reason why CPI is so unbelievably important for us right now is because we're trying to figure out if we are going to get back to normalcy and fix the problem that we are currently dealing with inflation. So usually CPI data is not really discussed too often and has become very relevant ever since we had COVID occur. So for years prior to that, CPI data was not something that was heavily acknowledged. And then COVID happened, and we had a cycle through COVID, and then we had what we're currently dealing with right now. So it's very much important when we're trying to identify all the parameters that are involved with high inflation. So and identify when we will reverse ourselves out of that. So those are the big factors for me. And I hate that they're relevant, but unfortunately at this time they are, and we need to pay close attention to them, or to CPI specifically.
Yeah. I definitely get your point, but also, in normal times, CPI will still produce, a reaction in the market for the most part, just for everybody's knowledge.
No, unquestionably. I'm not saying that it's completely irrelevant, but it is so much more important when we're looking for a reversal in a high inflationary environment.
Definitely.
No, Logan, you're absolutely right. Yes, that's what I did not say. Yes, sir.
Cool. Awesome. Great point. Absolutely. And that brings us into something else that we actually have this upcoming week, which is the producer price index. So very similar to CPI, this is the change in the price of finished goods and services sold by producers. It is a leading indicator of consumer inflation. When producers charge more for goods and services, the higher costs are usually passed on to the consumer. So, these things sometimes can look like a big circle, really. And also a news event that we're going to have not this next week, but the week after, when we have our federal funds rate announced, is the FOMC meeting, or the Federal Open Market Committee. And, this is a committee, I believe it's actually held out of New York, but the FOMC, they release a statement every time that we look at inflation, and this statement usually slightly changes, and it's these changes that the traders focus on every month, every time they're released. So it's a primary tool the FOMC uses to communicate with investors about monetary policy. It contains the outcome of their votes on interest rates and other policy measures, along with commentary about the economic conditions that influenced their votes. Most importantly, it discusses the economic outlook and offers clues of the outcome of future votes. So they're going to discuss what they voted on. In this case, they're going to be obviously voting on interest rates. They're going to show you what factored into their decisions, and that gives you a better clue as to how we're doing and how the economy is doing in total.
Yep, and just before we head on to the next slide, to really, really dumb it down for you guys, if you don't know what the FOMC meetings are, it's when Jerome Powell comes up onto the stand and starts talking about the economy. The head of the Federal Open Market Committee is Jerome Powell, and that's why his words are so powerful. So if you never knew what his job was or why he was so important, he is the head of the Federal Open Market Committee. So
yes, the Fed chair will often be the chair of the FOMC. Yeah, absolutely.
Yes. So if you don't know, now you know, right?
If you don't know, now you know. Cool. So moving into the federal funds rate, and if nobody is actually aware, the federal bank cannot actually change the interest rates that you're getting charged on your credit card loans, on your mortgage loans, or whatever it may be. But rather, what they do is they change the interest rates that they give to banks. So when banks need to borrow money, they go to the Fed, and they have to pay the federal funds rate. It's the interest rate that they have to pay to the government. So the federal funds rate is the interest rate at which depository institutions lend balances held at the Federal Reserve to other depository institutions overnight. So banks. Banks is really what that's referring to. And higher interest rates result in the market moving lower, usually. Interest rates control the saving, spending, and borrowing of the economy, and therefore really controlling businesses entirely. And, I definitely want to hear everybody's opinion on federal funds rate, because I feel like this is very important and what we're looking at very closely in the upcoming weeks.
I feel like Clayton would have some strong opinions on it. Is Clayton out there? No. Well, I think it's
Sorry.
Oh, go ahead, Clayton.
Okay. Sorry, I was trying to unmute myself. My phone's just not liking me right now. Okay, all right. So in regards to the federal fund rate, Logan nailed it on the head. This is the biggest thing. You guys will see that. We'll talk about from an institutional perspective. I won't get too conspiracy theory, but one of the biggest things that I acknowledge myself is when you guys see the banks and the institutions starting to push on the Fed to raise interest rates, that's when you start to see some give and take, right? The Fed and the institutions work directly with one another, whether it's through force or through negotiation. And sometimes the Fed wants to do what's best for the economy, and sometimes the banks want the Fed to do what's best for the banks. Right now, an increase in inflation, increase in inflation has directly caused an increase in the hike and deployment of these interest rate hikes. And what that's doing is, that's slowing business down for the primary business of the banks, which is housing. And on top of that, since it's slowing that down, they're also making more money on interest rates as a whole because the interest rates are going up, which means the borrowing is going down, but at the same time, they're still making more money on those increased rates. So we've been hearing from, if you guys have looked at the articles that all of these major banks put out, like Bank of America, Wells Fargo, Citibank, they have been pushing Jerome Powell to raise the interest rates up so that they can start getting some more money for the interest because it takes so much manpower to deal with all these mortgages and houses we're selling at all-time highs. So it's very difficult to keep up for them. So that would be my point.
I agree. Federal fund rates are extremely important. And guys, I'm just going to come in here and give you like very simple terms that maybe you don't hear often or you don't hear an explanation for. But, this is really the difference between a hawkish environment and a dovish environment, right? A hawkish environment is when the Fed wants to raise rates, and a dovish environment is when they do not, right? So, paying attention to the federal funds rate is like a huge macroeconomic indicator that can drastically dictate how the market performs and what kind of volatility we see in all markets.
Yeah.
So
Well said. Well said. I think I want to take the perspective of, how this may affect the things that we do on a day-to-day basis in the server, for example. I think that what I pay attention to when I look at federal funds rate and when we have these certain events is the predictability factor. And, easier said than done. But we did see that over the last few meetings, there has been the talks of that 0.5% increase. That's what's predicted. That's what I believe the market's pricing in. Now, in the terms of predictability, what's not predicted by the market, as far as I'm concerned, is an increase in those hikes that they want to have. So whether that be a 0.75 or even a 1 point increase at that, those are things that I look at when I look at federal funds rate. So the predictability factor in that, and essentially how the market would react to that. So next Wednesday, to provide an example, I'm expecting a 0.5. I think the market is expecting a 0.5 hike. That's what they stated that was going to happen, that they're going to continue along that path. And we'll have to see how the market reacts. On another token, if they do go on the more hawkish side of things, that could pose some pretty negative impacts on the market. And like I said, alternatively, if there is any sign in peak inflation over the next few months, whatever the case, maybe they start to ease their aggressiveness with those rates, and that might have some positive implications on the market. So I just try to see kind of what the market might be expecting, trying to gain as much historical data as possible on what the Fed might be doing and how the market has reacted to these moves historically. So that's kind of just what I'm looking at when I'm looking at these metrics for myself at least.
I like that. And yeah, like Ben said, as of right now, the expectation for this next federal funds rate is a 0.5% or 50 basis point increase to 1.5%, I'm pretty sure. So we'll see what happens. That's in 2 weeks. Pretty big news that we will have to be aware of. And that brings us into advanced GDP numbers. So, gross domestic product. We all learned about this in school, I'm sure. This is the annualized change in inflation-adjusted value of all goods and services produced by the economy. And it is the broadest measure of economic activity and the primary gauge of the economy's health. And this is very important because, as you saw, if you did see, the last advanced GDP number we came out at, it actually showed that our economy was shrinking by 3%. which, that is a very good measure of, if looking at this correction in particular even, you can see, okay, if the economy is shrinking, combining with our other macroeconomic indicators, which I'm sure we can talk about combining all of these at the end of this presentation, but using GDP, using inflation, using the interest rate environment that we have to see right now and how they're hiking interest rates, I think it's pretty reasonable to say that we can see the economy going lower. At least that's things that factor into my bearish thesis. Again, that could lead into a conversation, so let's leave that for the end. But if you guys have any thoughts on the GDP numbers.
I think you hit it on the head. It could lead to a pretty interesting conversation, but the GDP without a doubt showcases that we're in a correction and things are bearish. So paying attention to that is definitely important. And that's like, if you guys have ever had an economics class, I'm sure the first thing you hear your professor talk about is GDP. So it's very important.
All right, and just to give an idea for when we had that crazy COVID capitulation, I think GDP decreased by something like 3%. Sorry, not 30% in that quarter. So it's a metric that not only us as traders and investors take into account, but also economists for other financial instruments, like we'll go into in the next few slides, debt, bonds, etc. So it's going to be important to keep this metric in mind.
Definitely.
Y'all covered it for me.
So,
Wonderful.
Ben, take it away.
Onward.
Okay, cool. So I'm not going to go too much into the history and the what. I think that junk bonds, the bond market, is a little bit boring sometimes, but this is a good time, like I said, to pay attention to this among the other things that we've covered. So just to provide a very layman's terms example of what a junk bond is, it's essentially just a fixed income. So in the sense that a fixed income debt instrument, in the sense that you'll get a rate of interest on the money that you pay for the bond, and it is fixed for the time. And the value of that bond can fluctuate, but the interest at which you get paid will stay fixed. So I will give an example of Coinbase. Actually, most recently, they issued a ton of bonds in, I want to say, late 2020. And essentially all it is that they say, you give us this money and we will pay you the principal amount that you put up plus the interest that we agreed upon that you'll receive. And usually these I'll call them agreements for simplest purposes. They are on a maturity period of about 4 to 10 years on average. Now, the issue is that there is no liquidity really in this market. You can't really, so you can only cash out, let's say 2 to 3 years after you make that purchase, and even then, your only liquidity is between you as the buyer and then the issuer. So it's a market to where you probably won't see people like you and I playing with it too much. It's relatively a pretty institutionally dominated market. But nonetheless, I want to go a little bit into why I pay attention to this, and why others do, and why I think it's an important economic indicator. So much like equities, these do behave in the same boom and bust cycles. So you'll see high yield bonds and junk bonds go up. And to give you an idea, these are things that are on a rating. There's all types of ratings. I don't think it's too important to know. Just understand that anything double B and below is considered a junk bond. It means that it's a higher risk of defaulting, aka you not getting your money back. So these bonds do move like equities in these boom and bust cycles that we have. And the thing is that with these high yield bonds, it's a massive market. We're talking about something like $1 trillion worth of issued debt. And while economic conditions might be good, this debt can be fulfilled, rather easily, or at least easier than an economy that we're in right now. So the idea of the valuations of these bonds, if you guys put two and two together, is that the more risk around the more risk around these bonds getting defaulted, the less they'll be worth. And vice versa. If people think that these bonds will be fulfilled, then they'll want to buy them. So when we think about a company's financial situation, if the market makers or the economy or if people generally think that a company's financial situation is looking bleak, then it's safe to say that they'll have issues on repaying their debt or repaying any credit that they might have going on. So that's kind of the first thing that comes into line, is that when things, you know, hit when the dog poop hits the fan, so to speak, they need to pay out their debt first. And if people think that they can't do that, then why would they pay for bonds on which they're expecting this company to pay them back for, especially over, say, a 4 to 10 year time horizon? Um, so these are things that I look at to gauge the markets and to gauge the economy in general. Usually, more than often, this is a leading economic indicator. So, when the credit market tends to get heated up, that usually precedes economic downturn. So, the credit market goes awry, and then we'll see what happens to the economy after. The credit market is not too crazy right now relative to, where we were in '08 and whatnot. I don't even compare it to then. That was absurd. But still, there is a lot more money in the game, and the issuance of bonds by some of companies such as, and I'm just going to name a few off the top of my head. I think Coinbase, Netflix, I think Snapchat, Ford. These companies are issuing bonds, and while they may be in a good state, if people think otherwise, they'll start to pull out of these high yield bonds first. And then they'll maybe start to think, okay, the stock might not even be worth at this if they can't pay their debt based on these balance sheet metrics. So I know it's kind of a mouthful, but I hope that this was a little bit helpful to give you guys an idea on a little bit on the what, and just as to how at least I look at it and compare it to my analysis on the overall economy. Logan, Austin, Clayton, if you
Yeah.
guys had any other questions. I feel like I'm better at like answering questions about this than explaining it, but
No, I really like that. So, to give people a little bit more of a clue, and this is something I look at myself as well. What do you look for specific? Because I know you look at HYG. That's the ticker that you look at for the high yield bonds. What do you look for HYG to be doing, and how do you correlate that to SPY?
Sure. Okay, let me pull up a little trading view just for my assistant. So HYG is I believe it's an ETF. And essentially, it holds some assortment of high yield bonds issued by governments and corporations. If you pull up the chart, and you can see that this, like I said, this follows in our boom and bust cycles. So when things go bust, so to speak, in 2020, and other times, these will more than often follow before the fact and go higher after the fact before the market actually does. So right now, for example, we can see the HYG, or at least the ETF that tracks these corporate bonds, these corporate high yield bonds, printed a new low, I believe, on yesterday's session. So I was talking to you about this, Logan. To me, this implicates that we're headed lower in the market. So it's not a one-to-one necessarily, as many indicators shouldn't be all reliant on one, but I do think that it's a very strong implication that of the highest risk assets, people want to get the hell out of them. For what reason, we'll come to find out. Maybe we came to find out after yesterday's numbers. But that's just a little bit of what I look to when I see these things.
I loved that last sentence that you said. If people want to get out of the higher risk assets, that usually is an indication of something. And I feel like that's the best way to summarize these.
Right. Yeah,
Absolutely.
exactly. Because at the end of the day, we can look at a few of these other things. I think I would love to put Bitcoin in the same pool of high risk assets, but it's just not traded the same way. Not just yet. I mean, there is institutional money, but it's not traded in the same way that institutional money moves around in these markets. So, like Logan said, I mean, that's kind of the thing to take away from this is, if people are getting out of the riskiest thing, and being that this risky thing has a time horizon of, let's say, 4 to 10 years, what can that implicate about the equity market, or about the other related markets for that matter?
Yeah. Yeah. No, I love that. And, bonds are a very long conversation, so if anybody has questions, we'll be happy to take those at the end. We could talk about bonds for probably days, but Clayton and Austin, if you guys have any other thoughts on these.
I have nothing, man. That was wonderful. Everything you guys said there is perfect. And I think the last thing that you mentioned, where when you see people going into bonds, it's probably a good idea, or it's probably a good signal that things are a little higher risk at the moment. So.
Oh, one more thing that I wanted to just point out, just with rates, by the way, rates, at least from what I understand, they're not too much of an impact on these high yield bonds. They're more so impacting the 30-year Treasury bonds. So that's something that I'm just wanted to throw out there, is that while rates do have somewhat of a relationship with these high yield bonds, I wouldn't necessarily peg it to one another. I'd pay attention more so to the 30-year and how rates might affect that. Yeah.
So just to summarize these one more time, essentially, if people are getting rid of junk bonds are going lower. People are scared of what the environment, the macro environment has in store and where the economy is going to be going. Usually, like Ben said, that can be an indication of lower prices across the market. Cool.
Yep.
So right before we go into Austin's, just wanted to quickly highlight the last couple of things we went over. Research, understanding, and implementation. The best thing that you can do if you want to get more familiar with the things we're talking about, because I know when I started learning about these, it was incredibly overwhelming. Now, after reading a lot of financial news articles, books, etc., I've taken certifications on this stuff. Just reading is going to be your best friend, and understanding where these things kind of fall into place, and also bring it up in conversation in the live calls, because we love chatting about any of this stuff, really, or even in stock chat. But reading financial news articles, books, etc., can expand your knowledge of what measures are put in place and for what reasons. And all of these are going to be obviously much more important for higher time frame traders. We did discuss a little bit about day traders understanding about these things earlier, but we did say this right here. Short-term traders can capitalize on macro news as well, usually around these high impact news events we've been talking about. But for higher time frame traders or investors, understanding the macro landscape is essential for their trading business. And Clayton, I want your opinion on this as soon as I'm done talking. It can save you incredible amounts of money and can help you make more. If you're able to identify changes in trend due to those macro variables we've just been discussing, it will allow you to exit at better prices, utilize bearish trading strategies to capitalize on the downside, and allow you to see when the optimal times are to get back into the market. That's my 2 cents. But Clayton, how do you view it? Because you're our investment specialist here, the long-term guy. How do you see it?
Okay, so Logan, that was phenomenally well said. Now, before I answer that question, you mind if I ask you a question quickly?
Sure.
So all my partners and my macro guys that I talk to, one of the things that we are trying to work on is during these bear market cycles, and my fund guys, one of the things that we're trying to work on is take the least amount of risk possible, but still get an exceptional amount of cash flow during these sideways bear market cycles that are predominantly 15 to 20% plus down from where the S&P 500 previously peaked at, and we're looking to generate cash flow. So you mentioned bearish trading strategies or strategies that rely on us moving down rather than up, I would assume. And I know that that would be super beneficial for people to hear about. Do you mind going into that a little bit?
Well, it's so funny you say that, because when I wrote that sentence, I was thinking about you. So actually, could you go into that? I was hoping you could just quickly go over bearish trading strategies. Obviously, buying long-dated puts is one, but that's not like a really good option when you're looking at minimizing your risk. But Clayton, tell us about covered calls. Tell us about spreads that you can utilize.
Yes, sir. No, absolutely. Okay. So, guys, this is I won't make it too complex. Not a lot of this is very difficult, but there's a lot involved in what it is that I'll be briefly discussing. So there's a lot of different ways that you can go about doing this. So two strategies that I deploy to increase my cash flow during times like this, and at the beginning of a bear market cycle, guys, when you bring in all the factors that are incorporated with beginning a bear market cycle, that Logan was talking about, a lot of different factors, you get really good at timing when we're about to go into a poor economic circumstance or environment like we're kind of in right now. So one of the things that I'm doing in the short term right now is covered calls, like Logan said. Covered calls, I'm doing short-term weekly covered calls, and I'm selling calls against 100 shares or a zero point 0.7 or higher delta long call that's acting as 100 shares. So I'm selling calls against a few dollars out of the money. What I look for is about a 0.3 to 0.2 delta, and I look at a range. I've taken a lot of TA help from Logan and Austin to really identify a good pinpoints for where I would deploy these calls. And what I'm looking at is a 5 to 15 minute chart, and I'm identifying, okay, what was the highest price of SPY during this period of time, and then what was the lowest price of SPY during this period of time, because I'm running covered calls on double and triple leverage. So SPY is my primary indicator leading, and then I just associate that high and that day with the respective double and triple leverages. And give you an example, I'm running long calls right now on TQQ for January 20th, 2023, and I made $100 per long call this week, and I'm spending a little over $1,000 per long call, which means I'm netting 10% right now. That's a little on the higher end. I did very well this week. There's a lot of volatility, so it was easy to get in and out of those covered calls. But that's one of the things that I am deploying right now to provide me a lot of dry powder. And what I'm doing is I'm taking that dry powder and reinvesting it into further building my long call side as well as more shares. While we're in a downtrend as we are now, you can utilize bear call credit spreads or put debit spreads as well to limit your risk and limit your down payment for these contracts and these spreads. And there's a lot of different other strategies, but that's something that Logan, Austin, and I can go into maybe in another time.
Perfect.
I don't want to drive us too far away from this.
Yeah, absolutely. No, great point. So,
Yes,
covered
sir.
calls,
I'll be right
just
back.
quickly give them, just what are the names of the things that you were just referring to? Covered calls, bear call,
Yes, sir.
credit spreads.
So I get very specific with the naming. So we have long-term, farther out expiration dated calls, and then I have short-term covered calls that I utilize when we're in the middle of a bear market trend. Now those long-term calls are deployed when we get to all-time highs because inevitably
We can go over
we'll go up a little
deployment
further.
later. We can go over deployment later. Do you want to just say
Okay.
what the names are of the strategies?
Yes, sir. So covered calls, and then bear call credit spreads, and then put debit spreads. I don't recommend shorting. It's a difficult process, and you're borrowing shares. But again, put debit spreads, bear call credit spreads, and covered calls.
Awesome.
Yes, sir. I'll be right back.
So Austin, take it away.
Cool. Yeah. Clayton, thanks for teaching us your strategy. Appreciate it. No, but moving on. So Logan, well, all of us for that matter, covered a bunch of stuff revolving around macroeconomic releases. Now, this is kind of similar, right? It still applies to the macroeconomic landscape, but we're looking at broader macroeconomic indicators, right? And these are like actually so broad that, just looking at them can give you an idea of where the state of things are. So we're going to be going over commodity prices, housing prices or house prices, and the stock market. I also mentioned a little bit about our currency stability and strength here shortly. So onward. On to the next one. Cool. So commodity prices are super, super important, and they've played a huge role, especially recently, in the macroeconomic landscape. If you guys are unaware about like what a commodity is, it's pretty self-explanatory. A commodity is a tangible, meaning that you can touch and hold it, economic good/resource that can be bought, sold, or exchanged for products of similar value, right? Okay, and this means it is fungible. Now, people might get confused by that. All fungibility refers to is the interchangeability of an asset, right? Certain amount of gold is worth a certain amount of gold to somebody else, right? And this is largely the same for most, if not all, commodities. There are certain exceptions to it, but commodities, for the most part, are known for being extremely, extremely fungible. So I hope that makes sense. Some examples here. Whoops, I don't know why I just lost your screen. Yep, some examples could be precious metals like gold, silver, agricultural goods like corn, soybeans, wheat, milk, sugar, etc., and energy stuff like crude oil, propane gas, or propane gas, and so much more. Now, I actually have a list of all these commodities. There's like hundreds of different commodities from, like I said, the precious metals like lead, zinc, tin, aluminum. I only mentioned gold, silver. You have copper, all that stuff. You have forest products, all energy, livestock, and meat. Like I said, the agricultural stuff. Like the commodity market goes fairly deep, right? So
It goes very deep.
understanding what a commodity is the first step to understanding the prices and how that affects the macroeconomic landscape. So why would you ever care what commodities are or what they do? Well, commodities are often used as inputs in the production of other goods or services. So I hope that makes sense, right? So gas, for example, is a commodity that is right now very, very expensive. This impacts how our economy functions, right? How people get to work, how stuff is shipped from place to place, how people are traveling, everything. Like just the movement and production of goods and services can often change very rapidly depending on the prices of certain commodities, right? And Logan, I definitely want to hear your takes on commodities here shortly, but I know we often look at wheat, right? Wheat went like parabolic a few months ago. It was something to behold. I believe wood also went crazy, right? And that affected a lot over at the construction side with building houses and building whatever, right? Anything that wood could be used for was very much affected by the rise in that. So we know that the prices of commodities are important and that they can affect how our economy behaves. But how would you go about observing this, right? So there are many, many online sources that display current commodity prices, such as Bloomberg, CNN Business, etc., right? Any financial website will give you the updated, what is wheat trading at, what is gold trading at, blah, 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 blah. But you can also find broader commodity gauges, such as indexes like DBC, right? And this can be found like right on TradingView or any of your brokerages that you can chart an asset with. So DBC, if you guys just want to go, right, $DBC. Logan looks at it all the time. It is the commodities index, and it kind of just shows how overheated or underheated or kind of where commodities stand relative to recent history, right? Just like a stock, right? Where does it stand relative to where it was a year ago? Oh, well, the price is higher or lower, right? This index gauges where commodities are at this very moment. So commodity prices, guys, very, very important for understanding the current health of the economy, right? When commodity prices are sky high, it usually is not a good thing. When they are low, it means that a lot of things can be much more affordable and the economy can function much more seamlessly.
I love that.
So yeah, gotta understand that. I definitely want to hear some takes before we move on to the next topic. But
yeah, I definitely like what you just said. Commodities are something that I look at quite a bit, I would say. Especially energy right now, because I feel like that is super easy to play, especially for us stock traders, because we could play directly correlated stocks like Exxon, Chevron, things of that nature. But you can also do the same with gold. There's GLD. And something I also wanted to say is you said that you can find sources online of commodity prices. You can also find them on TradingView. You can find a lot of things on TradingView, but gold would be XAUUSD, silver would be XAGUSD, corn, soybeans, lumber. You can find all of those things on TradingView just by typing it in. But I think it's very important to keep an eye on these things. You can definitely find a correlated play in the stock market just by looking. That's really all it is. And I think it's very valuable to keep an eye on these prices. Just for inflation, for whatever purposes you could see. I look at them all the time.
Yeah, and I love that how you said, like, if you see a commodity rising, it could present an opportunity in the market. The thing that came to my head when you said that was like lithium, right? Like I think lithium is going to be one of the most important commodities here in the next decade to 2 decades because computer chips and our online worlds are so important to us. That and car batteries, right? We're moving over to electric vehicles slowly. I mean, I guess it's quickly but surely, slowly but surely. I don't know. But yeah, lithium is going to be a huge commodity, I think, going into the future. A little bit of a trade idea for you guys. I would definitely be looking into lithium stocks. I think that could present a absolutely wonderful opportunity here.
Yeah.
So that's just one of the many examples.
And that could be another reason you buy AMD or Nvidia or another semiconductor company or electric car company. You could say in the next couple of years, I think lithium is going to appreciate. These companies utilize lots of lithium, therefore they would appreciate on the rise that we see in lithium or commodity prices, whatever.
Yeah,
it may be.
do you know how much lithium Tesla needs to manufacture its vehicles? It's like unreal. The demand is like higher than ever before, right? And how do supply and demand economics work? Well, when there's a lot of demand and not a lot of supply, it drives the price extremely high, right? Not always the case though for commodities, I will say, right? Like right now the demand for, would you say the supply and demand for oil? I would say that the supply isn't really scarce, right? That there's just a large demand and there's a lot of like bottlenecks, right, with how it's being distributed and whatnot. But that's another conversation.
Yeah, exactly. Without getting too deep, that's there's other things that are causing that, but it's not necessarily a supply issue. It's a supply issue because of those bottlenecks, because of embargoes, because of things like that.
Right. Supply chain, V chain. Go look it up.
Yes.
Move on. On to the next one. Housing prices. And guys, I'm staying super, super broad here. I'm not going too much into specifics. I think you guys understand kind of what I'm saying when I talk about housing prices. The changes in housing prices can be found, or can be one of the many strong economic indicators that display the strength and direction of the economy. Right? Why would we ever care about housing prices? Well, knowing the state of the housing market can often give you an edge when it comes to future investments in any market, right? And a good example of this is like when the housing market gets extremely overheated or is very, very cooled off, it can very much symbolize good times to participate in markets and to back away from markets, right? I mean, go look at 2008, right? Great example of this. How can you visualize or how can you find how the housing prices are fluctuating and moving? Well, the housing price index is probably one of the biggest ones, HPI. Or I was talking to Ben recently, and he suggested the S&P Case-Shiller U.S. National Home Price Index, and they're relatively the same thing. They just kind of look at each other through different metrics, but it altogether, just shows the same line on the chart where, right now housing prices are going parabolic, if you guys aren't aware. So these index kind of quantify and visualize the general state of the housing market. And, I think it's definitely something you should be paying attention to, right? How expensive are homes, right? So on top. Hang on.
Oh, sorry, I just lagged out. Can you see my screen?
Oh, did you? Yes. Did you have anything to say about housing prices, Logan?
Nope. Everything you said was great.
Uh-oh.
He might be lagging out. I'll add a point.
Okay, let's hear it.
One thing that I'm not necessarily too cautious about right now, because I think it's okay, but defaults also are important, especially when we're talking about rate and housing prices. I mean, I think in terms of data that I've been looking at, subprime defaults have been up. I've seen specifically on auto loans. I haven't seen too many data points around anything crazy with defaults on housing just yet. But that is something that I'll be paying attention to as well, in accordance kind of with this topic.
Absolutely. Logan, do you have any thoughts on the housing prices, housing market in general?
No, I did lag out, but I just agreed with everything you said. Sounded great.
Cool. Okay. And last but not least, guys, we'll actually have something very quickly after this that I'm going to mention as well. But the stock market, right? What better way to gauge how the economy is performing than the stock market? If you guys are unaware of what the stock market is, I would be surprised. I don't know why you're in here. Maybe you trade Forex or crypto or whatever, but I would imagine that you are aware of what the stock market is. For those who are not aware of what the stock market is, I'm going to give you a quick definition. The stock market, or the equity market, as I call it, is the totality of buyers and sellers of stocks which represent the ownership of businesses, centralized businesses. And you should absolutely care what the stock market is and how it's performing, because it is, to a certain extent, the direct representation of the state of the current economy. Now, I say to a certain extent because, would I say that the S&P 500 at all-time highs recently was a good indication of how we were performing as an economy? Not really, right? Everything was really expensive. Inflation was sky high. The cost to live was getting out of whack, right? But yet we were making all-time highs. So the stock market is not always a great indication to how the true economy is behaving, but it is an indication as to kind of confidence and sentiment in markets, and how willing people are to still participate in these markets to buy shares and own parts of companies. So the stock market making all-time highs is typically a good thing, right? A good metric. And if you go look at the history of the stock market, right, from the 1800s, it usually goes up, and that is definitely a signal of how the U.S. economy has performed since its inception, right? It's done exceptionally well. If that economy just went straight down, right, I don't think we'd be having this. I don't think the U.S. would even exist right now. So the stock market, by many terms, is the best way to view how the broader economy is behaving. Now, how can you best find how the stock market is behaving? How is it performing? Well, my take on that is just by observing the S&P 500 index, or SPX. There's many other indexes that you can view, but the S&P 500, in my opinion, is the best way to gauge the current health and strength and direction of the economy. So yeah, that's very, very important. Anybody have any thoughts on the stock market, as general and as obvious as it might seem? I would still love to hear some takes about how the stock market kind of showcases economic health. Logan, Ben?
Yeah, I mean, I agree with you. It is definitely something to be important to keep an eye on. The good thing is that we keep an eye on it all day long.
Every day.
And it just so happens that
That
most
is a
of us,
good thing.
yeah, it just so happens that we're looking to capitalize in the stock market using the rest of the things that we've been talking about. But yes, if you are objectively just looking for the health of the economy, it's very good to see how individual businesses are doing, and the S&P 500, like Austin said, is the best way of seeing how businesses across the board are doing. Unless they're uncoupled and now down 70%, but those are just some stocks.
And just to piggyback on that, I think you'll like the way that I'll word this, Austin. But it's a prime example of the many deviations we've had across a few things. And I mean, clearly, when we were at pumping past 400 to 480 in a matter of I don't recall how many weeks or months, but it's safe to say that should not have been the case, given the current economic environment. So sometimes things get brought down in accordance. Sometimes the stock market is not the economy, and the economy is not the stock market. But there are times when these things will line up.
Well, I think they always line up, because you just mentioned a great thing, which was like a divergence, right? You noticed, wait a minute, the stock market's making all-time highs, but in reality, I walk outside and I'm paying a crap ton of money for a gallon of milk. So there's obviously a divergence from how the actual economy is performing and how the stock market is performing. Therefore, maybe the stock market's going to come down a bit and kind of realign itself with things, right? And that could be a wonderful trade idea, give you good insight to how things might behave in the future. So yeah, sometimes they do line up, sometimes they don't line up, but either way, you're getting insight at all times, right?
Just
Very,
wanted
very
to
good.
just want to add something to what you just said, Austin. You and I have spoken about this multiple times, but when we're looking at the stock market and we're comparing it to economic indicators and inflation or different things that could be occurring within the economy in 2008, it was the banks going down. Something that I learned from you and Logan was to look in different asset classes, and what I specifically learned was look at crypto. Ethereum and Bitcoin started getting crushed prior to us starting to really see heavy downtrends in massive individual securities within the S&P and the NASDAQ. So if you're looking to broaden your horizons with the market and trying to better understand what goes into the market, start looking at other asset classes as well, because it gives you a more broad picture. Like I believe it or not, and I don't think anybody knows this, is I started trading crypto before I started trading in the stock market. I started trading Bitcoin a long time ago. And what I did was I got past crypto and then I just completely threw it out the window. And now I'm starting to realize that it's a potential leading indicator for any macro trends that we may see in the market. So I just want to add that to what you said, Austin.
That's interesting. And, I'm not going to dive too deep onto like if crypto is a leading indicator or not, but what you said there is like super important. Looking at other markets can give you a ton of information that could be useful in the market that you're participating in, right? Even though I don't participate and actively trade the commodities market, observing it and paying attention to it could be something of use to me. So
Unquestionable.
yeah, absolutely. So before we move on to the last slide, which is the kind of ending slide, I do want to say that currency strength and stability is another one that's very, very important. And you can look at this by viewing DXY, which is the U.S. dollar index. Very, very important to see how that's performing. Typically, when the dollar appreciates in value, a lot of other things will go down, right? So very important to pay attention to the strength of the dollar, as well as paying attention. We talked a lot about interest rates, inflation, and all that, but paying attention to the money supply, in specific the M2 money supply. There's actually an M1, M2, and M3 money supply. They all kind of encase different ways of viewing the economy and money supply, some more liquid than others. I definitely encourage you to go research that on your own. But the M2 money supply is also a great way to kind of view the current, the strength and stability of not only the dollar, but of the general market. So paying attention to the U.S. dollar, its performance, and as well as our current money supply can be huge economic indicators. I often, and Logan does as well, we'll overlay we'll divide things by the M2 money supply to see how it's moving in correlation with the inflation rates. Right, Logan, I don't know if you have any thoughts on that.
Yeah,
so like we were looking at gas, right? You right. Overlaid, or was it crude oil, with the inflation rates? Are we at all-time highs yet with that?
Almost.
I think we're close. Almost. So like a good example is, everybody's saying gas is at all-time highs. Well, yes, the number you see at the gas pump is at all-time highs.
The nominal price is
on average. But when you consider the amount of money we have recently printed, it is actually not at all-time highs relative to our current monetary, circulation, right? How much money is in circulation? Gas is not at all-time highs just yet. So something very, very important to pay attention to.
Yes. And just to expand on that, I think it does depend on where you get your inflation data from. I believe some places say we are actually at all-time highs, inflation adjusted. When I looked up inflation data, we are not quite there, but we are very, very close. But again, depends on where you get your inflation data from.
I would imagine it's tough to find real numbers. Like I feel like the U.S. government themselves don't even know how many dollars are in circulation.
It seems that way. It seems that way.
Yeah.
And also for the DXY thing, just kind of answering the question, why do things go down when the DXY is going up? Well, it's because when you're paying for things, most of the time these things are quoted in dollars. So if your dollar has more buying power, like let's use Bitcoin dollar as an example, Bitcoin it may be falling in value, and it is right now, but it's also falling in value against the dollar because the dollar is doing so well. So it's like a double whammy almost.
Right.
Yeah.
When the dollar rises, other things will usually go down against it.
Also, consider the initial investment of Bitcoin and how long it's been around and what the returns are from Bitcoin. I mean, if you look at what it was 5 years ago, which is not even a long-term investment really. If you look at 5 years ago, you're still multiples above where you were with Bitcoin. Not to say that Bitcoin is the best thing in the world, but even though it's down, it's still, for long-term investors, which is basically what we're talking about here, the macro side of things, still doing very well.
Yeah, I think Logan was just kind of giving an example of like how things like that could correlate
with the dollar.
No, absolutely. I wasn't disagreeing. I was just adding on to that because
Yes.
just to take that macro perspective that Logan was discussing. That's why I brought that up.
Yes.
Yep.
Yes. And then one thing more before we go into our
Questions.
thank you slide, and Ben, I definitely want your opinion on this. It's just a little tip that a lot of people refer to, and that's the 10-year and the 2-year being inverted. You'll hear a lot of people talking about the yield curve going inverted, and all that means is the 2-year is higher than the 10-year, meaning that the government, the U.S. 10-year, is giving less of a payment than the 2-year is, and that is usually a very classic indication of a economy crash or an economy recession. So as of right now, as of Friday, the two yields were getting incredibly close, around the 3% mark. So, it's very interesting to keep an eye on that. I highly recommend looking into the 10 and 2 yield inversion. But Ben, if you have any thoughts on that, throw them in.
Sure. So, I mean, this has been a hot topic for, I think, the last, 3 months, maybe?
3 months
Something like
especially,
that.
but this has been a topic for, years.
Yeah,
Yeah.
for years. But as far as kind of mainstream goes, I think a lot of people see those headlines, and to me, it's something that I can look at and I can say, okay, we can take this at face value, and we can say, okay, the data shows that when this does happen, we are indeed a little screwed, for lack of a better word. But I'm gonna be honest. I do take this with a grain of salt. I think that although data does prove that this should be something that causes a particular economic downturn, I'm personally not too stuck on the fact that this is the end all be all, so to speak. That's really my take on it, to be honest.
Yeah. All right, cool. Well, on that note, thank you, everybody. And we can now do some questions utilizing our new chat feature on Discord.
And look at the timing on that.
Look at the time.
Beautiful.
Perfect timing. Just
Wow.
perfect. It was so beautiful.
You make me laugh, man.
On the dollar note, though, Logan, we did see a massive push after data from Friday.
Yep. Makes sense.
So it's chugging. The dollar is king. The dollar is the king of the markets.
Cool. Well,
Yep. And if people are still confused as to how the new messaging feature works, right near Investors Lounge, there's a little open chat button. You should see it if you just hover your mouse over it. If you're on desktop, and you can click on that. I'm not sure what it looks like on mobile just yet. I haven't done that. But chat rooms are a little bit different. If you have any problems with that, we will help you out.
cool. Well, I'm currently trying to fix the recording. So while we do that, if anybody has any questions, throw that into chat.
Or you can speak up.
Or
Doesn't
you can
matter.
speak up. Yeah.